We are kicking off today's deep dive with a major earnings catalyst out of large-cap pharma. Pfizer has topped quarterly estimates and raised the low end of its full-year revenue guidance. And the story here is less about what Pfizer sold during the pandemic and far more about what it is building beyond it. This is a company actively rewriting its own narrative, pivoting away from the COVID franchise that once defined it. And this morning's results suggest that pivot is gaining real commercial traction, with the broader market showing calm conditions and the VIX at 15.63. The macro backdrop is favorable enough for investors to genuinely price in this kind of operational re-rating. Here are the sourced facts. Pfizer beat consensus quarterly estimates on both the top and bottom lines, and critically, management raised the low end of full-year revenue guidance, a signal that core operational execution is running ahead of internal projections. At the same time, the company cut its full-year COVID product revenue forecast to $4 billion, down from approximately $5 billion, acknowledging that normalized post-pandemic demand has structurally compressed that revenue stream. This is not a surprise to Wall Street. Consensus had already modeled COVID revenues trending toward low single-digit billions annually, but the simultaneous guidance raise on the core business is the constructive element that matters most for the stock's re-rating story today. The deeper significance here is what this result confirms about Pfizer's commercial engine outside its pandemic franchise. For the past several years, the bear thesis on Pfizer rested on a single uncomfortable question. Once COVID revenue evaporates, what replaces it? This quarter's beat, driven by primary care and specialty drug uptake, begins to answer that question with actual revenue data rather than pipeline projections. Margin expansion appears to be a contributing factor, which matters enormously in a rising rate environment. The 10-year Treasury yield is at 4.74% this morning, up 1.76% on the day, and at that level, investors will ruthlessly compress multiples on any pharma name that cannot demonstrate durable earnings power independent of one-time windfalls. Let's run through the affected names precisely. Pfizer is the direct beneficiary. A guidance raise on core business fundamentals justifies multiple expansion if the 10-year yield stabilizes. Healthcare, the healthcare ETF, should outperform on this narrative shift, as large-cap pharma names like Johnson & Johnson also get lifted by the halo of sector re-rating away from COVID dependency. On the other side of the ledger, Moderna and BioNTech SE face compounding pressure. Pfizer's explicit cut of its own COVID revenue forecast to $4 billion validates the structural demand collapse thesis that has weighed on both mRNA pure plays. Smaller biotech may also underperform if investors interpret Pfizer's non-COVID commercial strength as evidence that large incumbents are capturing market share from smaller innovators. There are three specific things to monitor as this story develops through the session. First, the 10-year Treasury yield at 4.74%. Rising rates structurally compress pharma equity multiples even when fundamentals improve, so any further yield acceleration would cap Pfizer's upside regardless of how strong the earnings beat was. Second, watch healthcare at its cyclical resistance highs. A clean breakout above that level on volume would confirm broad sector rotation into defensive healthcare. Third, the VIX at 15.63 tells us markets are complacent rather than fearful, which historically supports a sustained re-rating of defensive names. Gold futures suggest some residual flight to safety demand coexists alongside the equity rally, up 2.47%, so do not read the VIX as unconditional risk on. The bottom line is straightforward. Pfizer's combination of a quarterly beat, a guidance raise on the low end, and a transparent reset of COVID revenue expectations to $4 billion is exactly the kind of clean, credible signal that re-rates a large-cap pharma stock. The non-COVID business is now demonstrably carrying operational weight, which directly addresses the core bear thesis that has suppressed Pfizer's multiple. The strategic playbook here is to build exposure to healthcare on any intraday dip, using the healthcare sector's defensive characteristics as a portfolio stabilizer, but maintain discipline around the 10-year yield at 4.74%, because if that number continues climbing, even the best pharma earnings story will face a valuation ceiling. That is the one story that matters today. Full breakdown is up. If this kind of institutional-grade market analysis is what you want every single trading day, hit subscribe right now and tap the notification bell so you never miss a breakdown. We cover earnings, macro, yield moves, and sector rotations, the numbers that actually move your portfolio, delivered before the open. Subscribe now and stay ahead.